Good morning, good afternoon, good evening, traders. Wherever you're tuning in from, it's such an honor to have this session with you. Thank you very much for tuning in. Well, I personally advise that you pay close attention to this session, as a lot of the information that will be shared are things that a lot of people are struggling with, especially as new traders. The information for today that we have packed for today are informations that would really mostly help people who are struggling with consistency, who are struggling with understanding the market better, who is struggling to have a firm grip of what the market is trying to relay to them as informations going forward. Now, today we'll primarily be talking about market structure. And before we dive into this topic, it's very much important that we understand the foundation of the market. Now, understanding the foundation of the market entails that, for one, we need to identify the primary participant in the market. Now, the financial market or any market, whichever you find yourself in, has two basic components. If you go to a supermarket, a mega market, a grocery store, a boutique, anywhere, even to a repair store, you find two people who are there as active participants. These people who are found there are the demanders, those who demand a product or a service, and those who offer the service, who in this case can be called the suppliers. So the market, any market, the financial market, which can be broken down into the crypto space, the forex market, the indices market, the commodity market, even down to the physical market we have, the grocery store and all of that, have these two participants actively available or present in the market. We have those who offer a product and those who render that product. Now, in the financial market, we have those who are buying into the market, who are called demanders or buyers, and we have those who are selling out of the market, who are called suppliers or sellers. Based on the financial context or the financial framework, these people are divided or called, in quote, the bulls and the bears. So the bulls are those who are buying into the market, and the bears are those who are selling out of the market. Now, as the name implies, for someone to be buying into the market with a hope or expectation of making money, it does imply that the person will most likely be buying at a lower value with the expectation or hope that the market will move higher in order for him to or her to make profit. So, in summary, bulls or demanders buy the market at low value in expectation that the market will rally in order for them to make profit. Conversely, sellers sell at a high value. They come into the market at a high value with expectation that price will go down. So the two active participants in any market structure, be it in the crypto market, the forex market, the commodity, whichever market we have, are the bulls and the bears. So the bulls buy low, which is basically the law of investing or trading, which is buying low and selling high. So bulls buy low when the market is low, and bears come into the market when the market is high. Now, coming down to market structure in itself, it's very much important for us to understand the direction of the market. Now, the direction any market is going in will give you a full understanding of who is in control of the market. So if a market is seen to be moving to the top side, this market is considered to be predominantly controlled by buyers, because, as explained earlier, buyers are people who push market or who hope for market to move to the top side, who expect market to create higher pricing level or higher highs and higher low formation. These are buyers or demanders. So whenever we see a market pushing to the top side, it gives us that mental indication of formation that this market is predominantly controlled by buyers or by bulls, as the name implies, a bullish market. Now, there's a misconception a lot of people are having prior to this class about the whole demand pressure, the whole demand and supply. Now, many argue that when we have more demanders than suppliers, we tend to see the market moving to the top side. I'm here to discredit that information. Now, the market is not moved by numbers. The market is moved by money or by asset or by liquidity. Now, if you have 10 people who are buying into a market and 5 people who are selling out of the market, it does not in any way imply or suggest that the market will move to the top side. Because for one, we cannot, for certainty, estimate what these 10 people have in their possessions as asset or as liquid cash. Neither can we determine what the 5 people have who are selling into the market have as liquid cash. So what moves the market in any direction is the presence of money or presence of liquidity. So if a market is creating higher pricing, we can, by virtue of this information that is presented to us by direction, understand or perceive that the market has more demand influence. And the demand influence in this case is more demand volume is being imputed into the market. Institutions or buyers, mostly institutions, to be brutally honest, the market is controlled by institutions. So institutions who have larger capital, who have more money under management, 1 billion and all of that sort, are the people who are primarily moving market in a particular direction. So the market is not moved by numbers, the market is moved by volume or order flow. Because a lot of people go online to sites and all of that, and they get information that, oh, X amount of people are buying into the market. We have 40,000 people buying into the market and 30,000 people selling out of the market. And by virtue of the numbers, it implies that market will move bullish or market will create higher pricing. It's not true. The 30,000 people who are selling out of the market might have more available resource to push the market to the downside. An example is Elon Musk. He bought into a company that was existing. He bought into Twitter. And Twitter, before Elon bought into it, had many people who sat as board of members. They had a board, and these people were there as board of members. Elon came, for example, and bought all of them out. So we have one person buying into a market that had many sellers. Elon was the primary buyer, but he was able to buy the market off all of the available sellers. So the number of persons or number of people who are available on one end of the market does not predetermine where the market will move. So that is one of the misconceptions. So in summary, the number of demanders or the number of sellers does not in any way determine market direction. Market direction is a primary function of liquidity and order flow. So when the market is creating bullish pattern by creating higher price and moving to the upside, we have it at the back of our mind that this market is predominantly controlled or invested in by large demand volume or large demand order. The same way, if a market is moving to the downside, we can have it that the market is being influenced by the presence or availability of large sell volume or large sell order in terms of money. So now the basic market structure is seen when a price for a bullish trend, for example, is seen when a price moves from a lower level to a higher level and then it makes a correction. Now, the fact that a market is bullish, which gives you the indication that we have more bullish order flow or more bullish liquidity or more bullish asset readily available, does not imply that we will not have sellers in the market. Now, any market is practically useless or incomplete if we do not have the two participants, which are the buyers and the sellers. So the fact that a market is bullish does not mean we do not have sellers in the market, does not exempt the presence of sellers. It only shows that we have more buy order flow or more buy volume or more buy liquidity than sell liquidity. So the asset under management for those who are buying into the market, the money these people are willing to invest into the market at that point in time exceed the money people are investing in the market in the opposite direction. That's what makes a market trending. So if we have a bullish scenario, if we have a bullish market, it does not in any way suggest that we do not have sellers available, because you cannot buy into a market if someone is not selling out of the market. You can't go to a grocery store and have a product if you don't have someone on the other end of the market willing to sell a product for you. So the same can be said for a bearish market. The fact that a market is moving to the downside, which gives you the mental impression that this market is predominantly controlled by large sell orders or large supply orders, or large supply liquidity does not in any way exempt or subtract the presence of demanders. Yes, you will find demanders in a bearish market, and yes, you will find suppliers, people who are willing to sell into the market in a bullish market. And that is why we have this formation, which is called a retracement. Now, the reason why price does all of this is so as to give everyone ample opportunity of investing into the market. So first off, we need to understand the direction of the market, because the direction of the market will give us a very wide understanding of who is the primary person or people who are in control of the market. So in every market structure, we have a market creating bullish patterns and a market creating bearish patterns. There's another market structure which is called a ranger market, but for this class, we'll primarily be talking about trending markets, which we have an uptrend or a downtrend. Now, looking at this market, you can see closely that we have two patterns. The two patterns of formation here for any market, of any trending market, is that the market makes an impulsive move to the top side or an expansion. So the first phase of any trending market is an expansion phase. Now, imagine this market is an athlete, or this market is a driver in a Formula One. Let's say Hamilton or someone else. I don't want to mention names so it doesn't upset other people. Let's assume this is a driver for a Formula One event. Now, this driver is on a race to move from one location, which is point A, to another point, which is point Z, for example. Now, this driver obviously will start his ignition at 0 kilometer per hour. At the start or after the gun makes a sound, whichever, whatever, if that's the case, this driver has a very high tendency. There's a very high tendency that this driver will move from the point he was in, which is at 0 kilometer, which is at rest, and accelerate to a certain point. Now, this driver will continuously accelerate or move with a high speed until presented with an obstacle. The obstacle can be a turning point, a curve on the track. For example, if this is not Formula One race, if this is a real event, if this is a real life scenario, you can be confronted with a reason for slowing down in the momentum. One of that reason might be that you come in contact with, for example, you're presented with a roadblock, a zebra crossing, or a speed bump. These are reasons that can make you slow down in your track. The same thing applies to the market. The market cannot move from point A to point Z without making a pause or without slowing down. Let's liken this. This can also be likened to an athlete who is involved in a marathon race. There is no way you can start a race at a pace and end the race, especially if it's a long distance race, at the exact same pace. There's a very high tendency that at some point coming along the way, you will see reasons to slow down in momentum. So this is what happens in the market. The market makes a move from its origin, which I call the protracted low, and rallies up or expands or makes an impulsive move to the top side, creating higher pricing. And at some point in time in the market sees reason to have a relaxation phase. This relaxation phase is what causes sellers or suppliers or supply order flow or supply liquidity to kick into the market and cause the market to move down, to create what is called a retracement leg or a correction. Now, the retracement leg can be seen as a phase where market moves from a higher pricing to a lower pricing. Now, as stated earlier, the fact that market is bullish does not in any way exempt the presence of sellers or of suppliers. So at some point, suppliers will kick into the market. So the movement that suppliers make, or sellers make in this case, can be momentary. What do we mean momentary? It can just span for a few periods. So it depends on the time frame you're adapting or the time frame you're looking at the market on. It can be, if you're looking at the market on the 1 minute time frame, the retracement leg that market might make can just span for 10 minutes, 20 minutes, 50 minutes, 1 hour, 2 hours, whichever, whatever. It does not, this retracement leg does not in any way suggest that the market has switched from a bullish market to a bearish market. Now, this is what happens in reality. The market does not give you this pattern in real life. The market does not move in this straight formation. In real life, the market gives you series of movements, and these movements are what, in to a very large extent, serve as the basics behind a lot of people not achieving consistency in the financial market. Because in the financial market, you get the market creating series of higher highs and higher lows, or all of that formation that suggests otherwise to what you saw before. So you can hop on the market today or hop on the chart and you go on a higher time frame, for example. You approach a higher time frame and you're looking at a higher time frame structure, and the higher time frame structure suggests that the market is bullish. Now, the concept of higher time frame structure is completely dependent on you as a trader. I cannot in any way tell you that the best place to get your higher time frame analysis is on the daily time frame, because we have a lot of people and we have these people suggesting different trading style. A lot of people are positional trader, a lot are scalpers, a lot are day traders, a lot are swing traders. So the type of trader you choose to be coming into the financial market will serve as the basics or foundation for choosing your higher time frame. So if, for example, you are a swing trader, you can have your higher time frame starting from the weekly perspective, having a weekly overlook of the market. If you're a day trader, you can have this time frame as the foundation or your higher time frame basis. So the concept of higher time frame is predominantly dependent on individual. I won't tell you that the best time frame to get higher time frame analysis is on the daily, because a lot of people who, for example, are positional traders start their analysis from the monthly time frame. They scale down to the weekly and then to the daily. So there is no holy grail for time frame. The time frame you choose to adopt as a trader coming into the market is predominantly dependent on the type of trader you choose to be. So if you're a positional trader, you need to understand where is the best place for me to get higher time frame direction. If you're a day trader, an intraday trader, a swing trader, whichever trader you choose to adopt, it will predetermine the analysis or the foundation, the time frame foundation for all of your analysis. But in summary, higher time frame and lower time frame most of the times confuse us, and that, in my opinion, is the foundation for losses or lack of consistency in the market. Because you can approach the financial market and on the higher time frame, whichever higher time frame you choose to adopt, it gives you clear indication of a bullish run. And how do we know it's a clear indication of a bullish run? Because price is creating higher price, and we've seen price creating higher level compared to the previous level. And this suggests that we have more demand order flow or more demand liquidity readily available in the market as against supply volume or liquidity. Now, the market is bullish on the higher time frame. Scaling to lower time frame is where a lot of people get it all messed up. A lot of people get it all confused, because you go to the lower time frame and you then start to see market creating bearish patterns, market starting to create lower lows and lower highs, and you get all confused as per what you should do at this time. A lot of people get completely taken aback by lower time frame analysis. I think that is a foundation for inconsistency in the market. A lot of people get overly wrapped up by low time frame analysis, and by so doing forget the primary structure, which is the structure on the higher time frame. So we need to understand that for any market that is considered trending, we have two phases. The first phase is the phase where a market, for a bullish market, where it moves from a lower level to a higher level, and this phase is called an impulse or expansion phase. The next phase is called a retracement phase or a pullback phase or a correction phase. And this phase of the market is seen for a bullish market, for example, is seen when the market moves from higher pricing to lower pricing. Now, as stated earlier, this retracement leg or pullback phase or correction phase can be momentary. So please do not get overly taken or overly confused by all of this movement. My best advice is, if you are not consistent enough as a trader, avoid trading in the pullback phase. Wait for market to create bullish pattern at a good pricing level before continuing in the direction of the higher time frame buyers. If the higher time frame is bullish, wait for market to start creating bullish order flow confirmation at a good pricing level. So the two things that you should highlight here: one, you should wait for market to start creating bullish order flow pattern, and the secondly, you need to wait for the market to be creating this pattern at a good pricing level. So for today, we'll not be talking about pricing. We'll primarily just talk about market structure. Now, if you look closely at the market, you see that this market, for example, has turning points. So these turning points are called swings. So every market presents us with two types of swing. We have a swing high. A swing high can primarily be denoted when we have three candles resting side by side. Now, this three candle will mostly have the candle in the middle as being higher than the two candles beside it. So how do you identify a swing high? You simply come into your chart and look for a point where we have three candles resting side by side, with the candle in the middle having a higher price level than the candle on both sides. So for a swing high, the open of the second candle will be higher than the close of the first candle, and also the open of the third candle. So this is candle 1, candle 2, candle 3. Again, for a swing high, the open of candle 2 will be higher than the close of candle 1. Same way, the open of candle 2, since this is a bearish candle mostly open at the top. So the open of candle 2 will also be higher than the open of candle 3. So this is how you identify a swing. So a swing high in a market suggests that perhaps a market is about to move in the opposite direction. It's similar to a Formula One driver approaching a curve. So this swing position, swing highs or swing low, suggests that the market is slowing down in order to move in the opposite direction. But note, this movement in the opposite direction does not suggest a change in order flow. It just suggests that market is perhaps about to reverse. Now, this reversal is or can be, in most cases, a short-term reversal. So price can create a swing high in order to move in a direction for a momentary phase or for a long-term phase before continuing in the original direction it was going. So imagine a Formula One driver approaching a bend and he slows down and makes a curve. That does not in any way suggest that his car is bad on something. It just suggests that at that point in time, he found an obstacle, which in this case is a curve or curved path, and he decided to slow down in order for him to make that curve. So making a curve does not suggest that your car is bad. Slowing down to make a curve does not suggest that your car is bad. So identification of a swing high will primarily be seen when a market has three candle formation with a candle in the middle, which is the second candle, having higher level than the two candles resting beside it. The opposite can be said for a swing low. So a swing low formation is practically seen when a market, still the same three candle formation, we have three candles resting side by side with the candle in the middle having a lower open than the close of the previous candle to the left, and also the open of the candle in the middle, which is the second candle, is lower than the open of the third candle. So this is a suggestion of a swing low. So coming into the chart, for example, we can see here, looking closely, we can identify that we have this as candle 1, sorry about this bearish candle as candle 1, this candle as candle 2, this candle as candle 3. If you notice, the market was moving to the downside. On getting to this price level, we found a swing. And how do we know this is a swing? We call this our candle 1, candle 2, and candle 3. If you look closely, you can see that the lowest point of candle 2, this is the low of candle 2, is lower than the low of candle 1. If you trace it out, you can see that the low of candle 2 is lower than the low of candle 1. Same way, the low of candle 2 is also lower than the low of candle 3. So this suggests that this is a swing. This, in this case, is a swing low, and a swing low suggests that the market perhaps is about to move in the opposite direction. Now, the move in the opposite direction, as we stated earlier, can be momentary. Does not mean the market has switched direction or switched bias. It just means that the market is perhaps about to move in the opposite direction. Now, looking for a swing high, you can clearly see the market presents swing high in every way. Now, would this be called a swing high? This can be seen as a swing high. Why? We can have this bearish candle as candle 1. We can have this as candle 2. We can have this as candle 3. Now, looking closely, we can clearly see that the highest point, the high of candle 1, is lower than the high of candle 2. Also, the high of candle 3 is also lower than the high of candle 2. So candle 2 is making a higher structure than the two candles resting beside it. If you're not using the high, if you're using the body of the candle, you can see that the close of candle 1 is lower than the close of candle 2, and also the opening of candle 3 is at the same level. So if you're using based on body, this will not be a swing high. But if you're using this market, analyzing this market based on wick, this can be seen as a swing high. So it depends entirely on what you're using as a foundation for your analysis. Are you using the wick structure or are you using the body structure? So another example of a swing high, you can see closely here, if you look at this position, this level here, where we have these three candles resting side by side, you can consider this to be candle 1, this is candle 2, and this is candle 3. If you look closely here, you can see that the close of candle 1, if we're using the candlestick body formation as the reason for our swing high or swing low analysis here, you can see that the close of candle 1 is lower than the close of candle 2. So candle 2 close has a higher level than candle 1. Candle 2 has a higher level than candle 1. So if you're using based on body, the fact that candle 2 and candle 3 are at the same level, you can at that point suggest that perhaps this is not a swing. But if you're using wick, you can see that the high of candle 2 is primarily higher than the open of candle 3. So this is how we identify swing highs and swing lows in the market. Now, the formation of a swing high or a swing low suggests that the market is perhaps about to make a turn. Now, as stated again, this turn can be momentary. Whenever we see a swing high formation, it does not in any way suggest that the market is about to move in the opposite direction. It only suggests that the market is perhaps about to change direction, which can be momentary, can be a momentary change in market structure. Now, let's go to identifying areas and levels of entering trades. Now, we cannot talk much about this because it entails a lot, but in my opinion, the best thing to do when trading in a trending market, as stated earlier, is for one, be not overly consumed by the internal structures that are being imprinted in the market on lower time frame, because definitely the lower time frame will create structures. These structures created by the lower time frame, again, the choice of lower time frame is totally dependent on you as a trader. So this market will definitely create substructures, which are structures that are created on the lower time frame. So the structures created on the lower time frame can serve as basics for your confusion. It can serve as reasons why you're confused. So in my opinion, when trading in a trending market, be it a bullish trend or a bearish trend, my advice is that don't be overly confused or taken aback by the substructures. What are substructures? Substructures are the structures that are created on lower time frame. Don't be overly confused by those structures. In my opinion, wait for price to create order flow that suggests the higher time frame objective. So if higher time frame is bullish, wait for market on the lower time frame to suggest bullish movement. Now, waiting for market to suggest bullish movement does not predetermine or give you that checkpoint that this trade is going to be a win. Because it's one thing for market to create bullish patterns, it's another thing for you to understand where is market creating bullish patterns. And that will bring you to the understanding of what is called pricing. So in as much as you're waiting for market to create bullish pattern in order to confirm that the lower time frame has shifted to correlate with the higher time frame, you need to understand that the best place to look into taking this opportunity is when price is at a decent level when we're talking about pricing. So now let's hop into the chart and look at price in order to see if we can identify trend. Now, if we start our analysis from here, which is the 28th of March 2022, we can clearly see that the market made a high. This high rallied down to make a swing low. How do we know this is a swing low? Again, we're using the three candlestick formation where we have three candles resting side by side. We can call this candle 1, candle 2, candle 3. Here you can clearly see that the wick of candle 2, the lowest point of candle 2 is lower than the lowest point of candle 1 and candle 3. So candle 2 has a lower level than candle 1 and 3. So if we're using wick configuration as our reason for looking at swing patterns, this can be seen as a swing. So the market in this example made a high, made a swing low, made another high, made another low. How do we know this is a low? Again, it formed a swing formation where we have three candles resting side by side, candle 1, candle 2, candle 3, with candle 2 having lower value than the two candles beside it. So if we're looking at the market, this is the last lower high. So this lower high formed this as a lower low. This lower low formed a high here. If you look closely, the formation of this high is obviously lower than the high resting before it. So this high is lower than this previous high. So by such, we can call this a new lower high. This new low high formed another low. We're using based on the candlestick formation for a swing point. It formed a low in the market here. And this low, if you look closely, this low is lower than the previous low. So this new low can be called a lower low. Now, this lower low has formed a high. Now, if we're looking at this level based on candlestick structure, remember, we said if we're using the body, this is not a swing high. But if we're using candlestick, we can see that the close, the highest point of candle 1 and candle 2 and candle 3, if we're using this measurement, we can see that candle 2 has a high that is higher than the highs of the two candles resting beside it. So candle 2's high is higher than the high of candle 1. Same way, candle 2 high is higher than the high of candle 3. So if we're using identification of swing point by candlestick, this is not a swing high. But if we're using based on wick, this is a swing high. So let's assume this is a swing high based on wick. So we can clearly see that this swing low, this turning point in the market, like a Formula 1 driver, this curve point at the market has created another curve in the market. So this high is lower than the previous high. So since this high is lower than the previous high, we can still call it a lower high. Now, this lower high failed to form a lower low because if a market is bearish, the market needs to create consistent bearish pattern of lower highs, lower lows, lower highs, lower lows, and all of that. So in this example, this lower high failed to form a lower low and it formed a new high here. So this high, if you look closely, is higher than the previous high. And also it's higher than this last lower high. So this new high can be called a higher high. But does this suggest that the market is bullish? This is where a lot of people make mistakes in the market. The fact that price has formed a higher high does not suggest that the market is bullish. In my opinion, before you can consider a market as being bullish, the market needs to create a high, a higher low, and then a new higher high. So this, if we're using this pattern, this is the first highest point we had because this is the first high that broke above the previous lower high in the market. So if this is the first high, so this level here is reflected as this level here. This level needs to form a higher low and then a higher high for we to confirm the market is now bullish. In this case, it formed a low pair, and this low happens to be lower than this low. So in all, this level, between this level and this level, is not a bullish market. This is a range. A lot of people will see this as a bullish market because price is moving to the top side. But a market can only be said to be bullish or trending, in this case, bullish, if it creates a high, a higher low, and then a higher high. For a bearish market, it can only be said to be bearish if it creates a lower high, and then a lower low. So the fact that price has not created consistent higher high or higher low formation for an uptrend, or consistent lower low and lower high formation, suggests that price is in a range, which brings us to identification of the third market structure. The two market structure we dealt with before were a bullish trend and a bearish trend. This brings us to the identification of the third market structure, which is in a ranging market. So right now, euro against the dollar on the daily time frame is in a range, but a lot of people might see it as a trending market. In my opinion, it's not a trending market because of inconsistency. So thank you very much for the time. Please do well to help the community by helping us with a subscribe. Help us with a subscribe, a thumbs up if you can, and also you can ask questions in the comment section, and we will try to do our best to attend to these questions. Do you have a beautiful day ahead?